So a lot of the HSAs are set up that, they want to have a certain amount that is in cash that you can use currently for medical type things. But then once you hit a certain threshold, then you'll be able to start investing that money. You can manage that just like you can your 401k or your IRA.
So it's almost like a tax-deductible Roth IRA.
Exactly. The thing is, once you hit 65, you can use that for your medical insurance premiums.
Starting your route to retirement.
Welcome to the Guided Retirement Show. I'm your host, Dean Barber. Today, we have back for the second time, Marty James. He's a CPA, also a managing director at Modern Wealth Management. And today, we're going to be talking about the Health Savings Account, the HSA. And Marty, as a CPA, says that this is some of the most misunderstood and underutilized part of the tax code. Please enjoy my conversation with Marty James. Marty James, Managing Director at Modern Wealth Management. Thanks again for being part of the Guided Retirement Show. Last time you were here, that was all the way back on episode 70. We're now on episode 98. And you want to spend some time today talking about what you say is the most underutilized and misused part of the tax code, and that is the HSA plan. So, Marty, first of all, welcome to the Guided Retirement Show.
Glad to be here.
So
shouldn't have waited that long, though.
I think you've been busy.
Yeah.
So let's talk about why you say the HSA plan. It's complicated, but it's underutilized and maybe misused in some circumstances. Tell me what you mean.
Yeah, so the reason it is so powerful, it's tax deductible in and tax-free coming out if it's used properly. And the only thing close to that is really like life insurance, but it's not tax deductible coming in. So, and of course the Roth, that's the other good. But with the HSA, I mean, it's a very simple concept, but they've complicated it in such so many ways that people just don't understand it completely. Most people think that it's an employer-sponsored HSA, so they think it's an employee account or an employer account, but it's really their individual account. And I think Morningstar, they do an annual study on HSAs, what you can do, who's got the best ones. And one of the things that they found is that only about 10% of the HSAs are actually invested for the long term. Most people kind of use this as in the accounting world, we call it the impress fund. You put money in, you take it out. If you're somebody can actually can afford to go ahead and pay out of pocket for your medical expense, but continue to fund that HSA, then let it invest it in for growth. And then years from now, I can pop that money out tax-free because I don't have to spend it this year. If I have receipts from 20 years ago, I can use those to reimburse myself. Perfect example, I've got a buddy who's a CPA in Phoenix. They had fertility issues, so they spent about $100,000 on fertility treatments and such. They ended up with twins. So he's been funding this HSA. He held this $100,000 back here. So when these kids go to college, there's the college funding totally tax-free, tax deductible and tax-free. So, that's, some of the things that you need to be thinking about. Now, for a lot of people, the money comes out of their paycheck and they put it in, which is usually the best way to do it, but they don't fully fund it. And a lot of times they empty the thing by the end of the year and they still have medical expenses outside that they paid out of pocket that didn't go through the HSA. Well, you have until April 15th April 15th to actually fully fund that HSA. So let's say I only put $2,000 in. If I had another $2,000 out of pocket, well, I can drop $2,000 in, get my tax deduction for last year, and then next day, or just as soon as the funds are available, reimburse myself. So you kind of want to plan for that. You want to be sure you have a source of money to actually be able to do that for a couple of days, and it could be the bank of mom and dad. It makes complete sense, to do that.
That's interesting. So Marty, first of all, you're saying that most people are doing the HSA plan that are doing it through salary reduction. But right. Even so, if you've got a plan that's offered through an employer, can that employee then go in and say, hey, I want to make a deposit to my HSA plan? It doesn't have to come from salary reduction?
Exactly. Where the salary reduction is better is the payroll taxes that you save with it going in through the salary reduction. When you actually physically write a check, you're doing that with after FICA type money.
I see.
But it's all still pre-tax.
Now, you made a comment earlier, Marty, that only about 10% of people that have HSA monies are actually investing it for the long term.
Right.
Talk a little bit about that, and how does a person actually control the underlying investments in that HSA plan?
Okay, so a lot of the HSAs are set up that, they want to have a certain amount that is in cash that you can use currently for medical type things. But then once you hit a certain threshold, then you'll be able to start investing that money just using the ETFs, basically anything that's available in, other accounts that you have, depending on the plan, obviously. But you can manage that just like you can your 401k or your IRA.
So it's almost like a tax deductible Roth IRA.
Exactly. The thing is, once you hit 65, you can use that for your medical insurance premiums.
So in other words, a person should be looking at this HSA plan really as a savings plan as opposed to just a health insurance or a health savings account. They should be looking at it as a retirement savings account.
Exactly. Just don't lose those receipts. And the thing I would recommend you do is, like the cash registered receipts or whatever, make a photocopy of them and get them in a digital format and then keep them that way. Because I don't know if you've ever tried to read a cash register receipt after it's 20 years old. It's just not happening. Right. So that way you've got a really good record of that. And that should be a permanent record, for you.
Now, there are a number of things that qualify for the expenses out of the HSA account. And I know most people get an HSA credit card when they have money in the HSA plan, and then they just use that credit card when they have medical expenses. What qualifies as a medical expense under the HSA plan?
Oh, it's a really wide list. You can have like smoking cessation programs. So technically, I guess the Nicorette gum would be considered as that.
What about like you go to the store and you're getting Band-Aids or cough syrup or, Tylenol? Does that all qualify?
Well, actually, what I have to do is I have to go look at the list to be able to tell you, because it's a very long list.
Anyway, we can maybe let's try to get a list. We'll get a list posted in the show notes so people can actually take a look at that list. But so I'm thinking about this now, and people should be really thinking about that HSA differently. And if they understood, hey, you're getting a tax deduction when the money goes in, if you can afford to put that money in there and you can use regular money to pay for any excess healthcare costs throughout the course of every year, you're just letting this thing grow. And it's not just your contributions. If you're investing it properly, it could be the compound growth on that can be used later in life, retirement years, to pay for health insurance expenses, to pay for all the prescription drugs, other doctors' expenses and everything. But you can't keep contributing after you retire, right?
Right. So the trigger is when you file for Medicare. Okay. So I turned 65, let's say, but I'm not going to file for Social Security, and I go on Medicare, I'm done. Okay. So the other thing is, let's say that I'm still working for an employer and I have I don't have to go on Medicare, but I make the mistake and I call and I sign up for Part A. That will blow you out.
Okay. So what happens, Marty, when somebody, let's say they've accumulated $150,000, $200,000 over their career in their HSA plan? What happens to that HSA plan when they retire? Does it stay with the employer, or does it roll over to another HSA plan that you're self-directing, much like you would an IRA or a Roth IRA?
Right. So that's it could stay there because it's really your account. So it's really technically not with the employer, which is why they give no guidance on this, because they have no exposure. But yeah, so even while you're working, say the HSA I have through my employer doesn't really give me any investment options, I can roll money out of that plan into one that does.
So you're basically controlling everything with that, even though it's an employer-sponsored plan. And what about self-employed individuals, Marty? How do they get money into an HSA?
Same way anybody else does. you end up with that self-employed. You got the self-employed health insurance deduction, but then you also have your HSA deduction that you make. That's, it's an adjustment down to that adjusted gross income number.
Now, is there a special type of insurance plan that an individual has to be on in order to qualify for the HSA?
Yeah, it's what we call a high deductible plan. So you have like high deductible plans for single people, and you have highly deductible for family people, which you can put more in with the family, which is kind of an interesting thing where people kind of mess up and they don't really realize it. I don't think it's been policed very well. Is back when the Affordable Care Act happened in like 2010, and of course, anytime they name something, they're lying.
Mm-hmm. Yeah, if it's affordable, it means hold on to your wallet.
What happened, it was, they said, okay, now your kids are going to stay on your employer health insurance until they're 26. Okay. For me to spend the money out of my HSA on my kids' medical expenses, they have to be a dependent. So if I have a dependent, or he was a dependent when, he went into college, now has graduated, but is still on my health insurance, that person's no longer on my tax return. I can no longer make medical reimbursements out of that HSA, even though they're covered underneath my health insurance. But the cool thing about it is that my son, let's say, is working for somebody else, but they're still on my health insurance. They're covered by a family high deductible plan. They can fund an HSA also, but it's not at the single rate. They can put money into the family rate. So this is a good way for parents that, have a little extra money, that they want to help the kids out, to really fund some of that retirement savings for healthcare.
Interesting. All right. So Marty, talking about the HSA plan, family plan, et cetera, single, are there contribution limits that people?
There are, and every year they're adjusted based on inflation. And the HSAs, when they kind of post a little earlier than most inflation adjusted, so you kind of know what that is. But one of the key things that people also figure out, so let's say I have a family plan, it's just me and my wife. So I maximize that out with my maximum contribution for whatever it is that year. But then let's say my wife is, she's 55 and, I'm 55. So, I get to do my catch-up plan, extra catch-up contribution to my HSA. So I'm maxing it out there. But my wife can establish an HSA also and do her catch-up contribution only to that. So that's how you're getting the most money in those HSAs.
So let me understand. You maxed out a family plan, but then your wife, because she's over 55, can establish her own HSA plan outside of your employer, even if she's not working, and she can put in the catch-up provision.
Exactly.
Now, what if your wife was employed by an employer that also had a high deductible plan and offered an HSA? Can you both do a family amount so you could get more money in there?
You're still going to be limited to that tax return limit of, whatever it is for the family.
Okay.
In other words, you guys can split it 50-50, or it could be whatever percentage, but there's a maximum amount that can go in.
All right. So that would really, the only thing she'd be able to do there if you guys were both employed is she would just put in the catch-up amount.
If I was fully funding mine,
yeah.
Yes.
Okay. So tips and tricks to, get money out. I guess if you've saved receipts over the years, when you take money out of that plan, you just send in receipts and they reimburse you. Is that what happens?
Yeah. Well, actually, you just reimburse yourself. It's going to be up to you to prove it to the IRS that you had these receipts.
So you take money out of
it to anybody.
You take money out of the plan directly. It doesn't have to go to a pharmacy, a doctor, a hospital, something like that. You just say, I'm going to make a withdrawal out of my HSA.
Right.
So then what happens when you file your tax return?
Well, in the tax return, you're actually, you're saying that I used all these funds for medical expenses, qualified medical expenses.
And so in the instance,
the burden of proof is on you.
So the instance that you told earlier, where a CPA friend of yours his wife had some medical expenses equated to about $100,000. In that year where he says, hey, I'm taking out my $100,000, or I'm taking out $25,000 a year to pay for college or whatever, he doesn't have to give receipts with the tax return.
Sure he has them, the documentation.
In the event that he is audited.
Right.
So I think the more I learn here with you, Marty, the more excited people should be about this HSA plan.
They should be. Yeah, they really should be. They should really look at that first. So I would say, if I had the choice where, I have limited amount of funds, I would do my 401k to get the maximum match. Then I'd be looking at that HSA to be sure that fully happens. That would be, now when you have the other people who can do both, do both.
But you have to have legitimate medical expenses from some time in the past,
right,
in order to pull that money out later.
Sometime in the past, once the plan was established.
What else? What else are people missing with the HSA, Marty?
Gosh, it seems like every year in tax season, that's where I spend the most time trying to talk to people. Here, you need to be doing this, and those are kind of really the biggies. They're just not using it properly, not maxing out that spouse's catch up. That's easily missed, and you just kind of be aware how old you are. When you turn 50, you get to put more money into your 401k. Well, when you turn 55, you get to put more money into your HSA.
Fascinating. Well, hopefully people have had an opportunity here to really, think about this whole HSA plan and how it should fit into be part of their overall retirement strategy. But Marty, you and I have been in this industry for, 3-4 decades each. And, the number of people that I get to see coming through the door that have accumulated $100,000, $200,000 or so in their HSA plan is almost non-existent. Yeah.
Because they spend it all. They think that's what they've got. I think it goes back to the old 125 flexible spending accounts.
Yeah.
Where they say, if I don't spend it, I'm going to lose it.
Right.
I think that's some of the mentality that's still out there.
So I don't think people truly understand that, hey, this can be a great investment vehicle for use for things that you want to do in retirement, as long as you've saved those receipts and have proof of it.
Yeah, and I know we're not talking about the ACA premium credits for that person who wants to retire early, but let's say you did have somebody they said, I'm retiring at 60. I've got everything in place to do this, and they know they're going to be doing this early, so they're funding their HSA fully, and they're accumulating these medical bills. When they're trying to bridge that gap to the Medicare to maximize credits, now I can reimburse myself and give myself some money to live on.
Very, very cool. Very cool. So here's what I would say needs to happen here. Anybody that's watching this, that somebody that's still working that qualifies for an HSA, forward this video to them so that, or if you're listening to it on podcast, forward the podcast series to them so they can actually understand the powerful impact of the HSA plan. And Marty, now I understand after talking to you why so many people are missing this and misusing it.
Yeah. And honestly, what's happening is you're preparing your return. You're trying to get it done. You're just getting the HSA information on there. You're not really thinking about what you could be doing. And most tax preparers, their job is just to get that return done. They're not thinking about, okay, this is what this person needs to be doing. Like I said, we spend a lot of time on the phone with clients during tax season, kind of tell them what they should be and what they could be doing.
Well, I'll tell you, if I could deduct the contributions into my Roth 401k and then know that could come out tax-free later, I think everybody'd be doing that. But I agree. People are thinking about this as put it in, get a deduction, and then spend it in the current year.
Right.
And
right.
So I've even seen people where they actually run out of money in their HSA plan.
Oh, yeah. Yeah. Because, we get the statements and we can see that there's zero balance at the end of the year.
Yeah.
And I know there's probably money that they spent that they could have been reimbursed for, and they have until April 15th to actually correct that problem.
All right. Great stuff, Marty. Marty James, CPA and Managing Director, Modern Wealth. Marty, appreciate you taking time to join me here on the Guided Retirement Show.
All right. Thank you.
Thanks again for joining me here on the Guided Retirement Show. I hope you enjoyed my conversation with Marty James. If you want to learn how to most effectively work the HSA into your retirement plan, you'll find a link to our calendar in the show notes. By the way, coming up in a season not too far away, Marty's going to come back and we're going to be talking about bridging the gap for healthcare expenses between the time you retire, should you retire before Medicare eligibility, how to qualify for the Affordable Care Act credits and still be able to have enough money to live on. Don't forget, we're offering you access to the same financial planning tools we use for our own clients. Just get out to the link in the show notes and click the Start Planning button and begin your retirement plan from the comfort of your own home.
Starting your route to retirement.
Thanks for watching. Subscribe here to get the latest from the show. Also, be sure to leave a comment and share this episode with your friends.
Investment advisory services offered through Modern Wealth Management, LLC, an SEC-registered investment advisor.